Welcome to the deep dive. Today, we're really focusing in on gold equities and, well, the picture is pretty fascinating.
It really is.
Gold itself is definitely flexing its muscles. It's holding strong above $3,200 an ounce.
Yeah, consistently.
And we've even got Goldman Sachs suggesting it could climb towards, what, $3,700 by the end of next year?
That's the projection. And there was that Reuters poll too, showing the institutional consensus is, generally expecting prices north of $3,000.
Right. So the big question, the million-dollar one maybe, is how are the gold mining stocks reacting to this pretty golden environment?
And that's where the story gets, well, really interesting. Because while the metal price is strong and the big producers, the ones in the GDX ETF, they've seen gains.
And some of the bigger juniors in GDXJ too, right?
Exactly, they've moved up. But the wider landscape of junior gold stocks, it's surprisingly lagging behind. It seems like the rising tide isn't lifting all the boats equally here.
Okay, let's try and unpack that disconnect a bit. Gold's hitting all-time highs. You'd think that enthusiasm would be kind of contagious across the whole sector.
Yeah.
So what's holding the smaller players back?
Well, there are a few key dynamics at play, I think. Historically, when gold really enters a proper bull market,
Yeah.
that initial wave of capital, it tends to seek the safety and, maybe more importantly, the immediate leverage of the major producers.
Oh, okay. The big guys.
Yeah, the companies with established operations, direct exposure to that higher gold price through cash flow right now. So investors often see them as let's say, the first and safest beneficiaries.
That makes sense.
Yeah.
The sort of blue chips of the gold world get the first look. What else is contributing to this lag we're seeing in the juniors?
A pretty significant factor is the lingering memory of past cycles. Many investors haven't quite forgotten the downturn that followed the 2019-2020 gold run.
But there's still some caution there.
Definitely.
Yeah.
Still a degree of caution when it comes to jumping back into junior explorers, especially. And the junior market itself, while it's also quite crowded, isn't it?
Yeah, there are a lot of names out there.
A lot of companies vying for attention, vying for capital, and frankly, many are underfunded, which just makes it harder for them to stand out to really make progress.
So it's a crowded field, and investors are being picky, probably looking for something more than just, blue sky potential.
Precisely. The majority of these junior companies, they just haven't yet clearly shown a viable path to actually producing gold, or maybe they lack those near-term catalysts.
Like drill results or permits.
Exactly. Those upcoming events like drill results, feasibility studies, project milestones, the things that typically spark investor interest and attract serious capital. So I think the core insight here is that in these early stages of a global market, it's often a flight to safety and immediate returns. It leaves a broader junior market needing to really prove its worth.
But you mentioned earlier that these mining bull markets, they tend to follow a pattern. What's the typical sort of evolution of where the money flows?
Yeah, the classic pattern is really a progression. Capital starts with the majors, the big producers. Then, as investors get more comfortable, more confident in the gold price, it moves into the mid-tier producers.
Okay.
And then eventually, the more promising junior developers, the ones closer to production, and the really high-grade explorers start to attract serious attention.
It sounds like you think we're maybe entering that phase now, where the focus might shift.
It looks like it. It feels like we're now entering that phase where carefully selected smaller companies, the ones with really compelling stories and, importantly, tangible progress, could really start to differentiate themselves.
But isn't there a risk in waiting too long? I mean, by the time the capital properly trickles down, haven't the best junior opportunities maybe already seen big price jumps?
That's always the tension, isn't it? You want confirmation, but you don't want to miss the boat.
Which is where it gets really interesting, because you've highlighted two specific junior companies you think are particularly well-positioned right now to potentially benefit in this evolving environment, GMIN Ventures and RUA Gold.
That's right.
So what makes them stand out from the crowd? What critical boxes do they seem to be ticking that maybe others aren't?
Well, both companies, kind of in their own ways, they really address some of those fundamental challenges we just talked about for juniors. They've got high-quality assets. They have clearly defined development or exploration plans. They operate in supportive jurisdictions, and this is key. They have near-term news flow or growth catalysts on the horizon, things that could genuinely attract investor attention.
All right, let's really dig into these two then. First up is GMIN Ventures. They trade on the TSX ticker GMIN. What's their story? What makes them compelling right now?
Okay, G Mining Ventures, or GMIN, they aren't your typical early stage explorer just, hoping for a lucky discovery. They are firmly in the developer camp. They have a very clear and actually relatively short timeline to actual gold production. And this profile, a company really on the cusp of becoming a producer that's precisely what tends to attract more institutional capital as a gold bull market matures.
Because investors start looking for tangible results, right?
Yeah.
Near-term cash flow.
Exactly. They want to see the path to revenue. So the key takeaway with GMIN is that combination of de-risked near-term production potential in a rising gold price environment. That's a powerful catalyst for institutional money and potentially a significant re-rating of the stock's valuation.
And their main project is Oko West in Guyana.
That's the one, the Oko West Gold Project in Guyana.
What are the headline numbers from their recent feasibility study? What jumped out at you?
Well, the feasibility study, which, importantly, they based on a $3,000 gold price assumption.
Which seems reasonable now, maybe even conservative.
You could argue that, yeah.
Yeah.
It paints a very compelling economic picture. We're looking at an after-tax net present value, or NTV, using a standard 5% discount rate of $3.2 billion.
$3.2 billion, wow.
Yeah. And just to clarify for listeners, NPV is basically the total estimated profit of the project in today's dollars after you account for all the costs and the time value of money. So a high NPV like $3.2 billion suggests this thing is potentially very profitable.
Okay, what about the rate of return?
The internal rate of return, the IRR, comes in at a robust 35%. That indicates a really high potential return on the capital they'll invest. And the payback period, just 2.1 years.
So they expect to get their initial investment back pretty quickly.
Very quickly, yeah.
Those are definitely eye-catching figures. What about the scale? How much gold are they planning to produce, and what's the estimated cost to get it out?
The study forecasts a 12.3-year mine life, producing, on average, about 350,000 ounces of gold per year.
That's significant production.
It is. And importantly, their projected all-in sustaining costs, the AISC, which is basically the total cost to produce each ounce, including operations and ongoing capital.
The key cost metric everyone watches.
Exactly. That's estimated at $1,123 per ounce.
Okay, so at current gold prices above $3,200, that suggests very healthy profit margins.
Very healthy. Even if gold prices pulled back quite a bit, they'd still likely be making good money. It indicates robustness.
So it's not just a promising study that's, gathering dust on a shelf somewhere.
Yeah.
They're actually moving forward on the ground, aren't they? Making progress.
Absolutely. That's a key point. Early works construction is already underway at Oko West. They're anticipating getting the final environmental permit in Q2 2025.
So next year.
Yeah, mid-next year. And they're targeting a formal construction decision in the second half of 2025.
Okay.
And this timeline is crucial because, historically, developers that have these well-defined timelines and strong project economics, they often see their valuations increase significantly. It's that rating process we talked about as investors start recognizing the reduced risk and the increasing likelihood of future cash flow.
That makes sense. But are there any, potential bumps in the road? What are the key risks that could maybe delay that permit or the construction decision?
Well, permitting always carries some inherent uncertainty, right? Even in supportive jurisdictions like Guyana seems to be. You need government approvals, environmental sign-offs. Things can take longer than planned. And then there's financing the actual build, though with economics like these, you'd expect financing to be achievable. Execution risk is always there too, building a large mine on time and on budget.
Okay, fair points.
Yeah.
So assuming they navigate those, what really differentiates G Mining Ventures from, say, other companies that might be at a similar development stage?
I think several factors really stand out. First, as we've seen, the project economics look genuinely institutional grade. These aren't marginal numbers.
Right.
Second, they have what seems to be a realistic and, importantly, time-bound plan to actually move into construction. It's not some vague future aspiration.
Okay.
Third, permitting and early execution are already in progress. That significantly de-risks the project compared to companies still just finishing studies. And finally, something that's increasingly critical, they appear to have a strong social license in Guyana.
Meaning local support.
Exactly. Support from local communities, stakeholders, that's crucial for long-term success. And the project is forecast to create, over 1,200 direct jobs in that region. That certainly helps build goodwill.
So the potential upside here isn't just tied purely to the gold price going up, but also to the company successfully executing its plan, ticking those boxes, and de-risking the project as it moves towards that first gold pour.
Precisely. It's about demonstrating progress and reducing uncertainty.
And what kind of time frame are we potentially looking at for this valuation reset or re-rating you mentioned?
Look, given their current momentum, the feasibility study results, and the key milestones they're aiming for over the next year or so, it's certainly conceivable that GMIN could see a significant step up in its valuation within the next, say, 12 to 18 months as they get closer and closer to pouring gold.
Okay, interesting. Let's pivot now. Let's talk about the second company you flagged, RUA Gold. Now, they represent a pretty different kind of opportunity, right? More focused on exploration, and they're in New Zealand.
That's right, a very different profile. RUA Gold is all about exploration potential, specifically in the historic Reefton Goldfield on New Zealand's South Island.
Reefton Goldfield. What's the history there? Is it well known?
It has a very rich mining history, actually. It produced over 2 million ounces of gold in the past, mostly, way back in the late 19th and early 20th centuries.
2 million ounces is significant.
It is. But what's fascinating here is that despite that historical significance, that proven gold endowment, the district hasn't seen a huge amount of modern exploration. Not much using the advanced geological tools and techniques we have today.
So potentially overlooked potential.
That's the idea. The crucial insight, I think, with RUA Gold is the high-impact potential of finding significant new high-grade extensions in a district that you already know contains a lot of gold, just using modern methods. It's kind of about unlocking forgotten potential.
And RUA Gold, they've managed to secure a pretty dominant land position within that district, haven't they?
They really have. It's quite remarkable. RUA controls something like 95% of the entire Reefton district.
95%. Wow.
Yeah, that gives them a massive advantage in terms of regional exploration upside. Their strategy involves applying sophisticated structural modeling, using high-resolution geophysics, and then very targeted drilling to identify and hopefully delineate new high-grade gold zones within this historically productive system.
And their main focus right now is a project called Old Creek.
Old Creek is the key one, yes.
What kind of results have they been getting there that's, generating some excitement?
Well, the early drill results coming out of Old Creek are definitely indicating the presence of a high-grade ore shoot. It seems to be plunging towards the south and, importantly, showing excellent continuity down dip at depth.
Okay. Any specific examples?
Yeah, we've seen some pretty impressive intercepts. Things like 9.8 meters grading 5.9 grams per ton gold equivalent.
Gold equivalent, so that includes other metals?
Exactly. It's a way to combine the value. In this case, it included 5.2 grams per ton gold and about 0.16% antimony. But even more striking, they hit a section of 1.25 meters at a very high grade, 48.3 grams per ton gold equivalent.
48 grams, that's very high grade.
It is. And that specific intercept included 13.3 grams per ton gold and a really significant chunk of antimony, 8.1% antimony.
Okay, those are some serious high grade hits.
Yeah.
But you mentioned something about the location of these intercepts being particularly noteworthy relative to their existing resource.
Exactly. That's maybe the most exciting part geologically. These high-grade intersections, they're located roughly 80 to 100 meters below the current inferred mineral resource area.
Ah, so deeper down.
Yes. And this is the kind of geological signal or vectoring that strongly suggests the potential for a substantial expansion of the known resource at depth. When you start hitting high grade like that, well below the current outline,
It suggests the system keeps going.
right, it can significantly reshape the overall resource estimate and, consequently, could have a really substantial impact on the company's potential valuation down the line.
Okay, but let's put that in perspective. A 700,000-ton resource, which you mentioned is their current base, isn't huge in the grand scheme of things for a gold deposit.
Yeah.
What gives you the confidence that more drilling will actually expand that significantly rather than just, proving up what they already have outlined?
That's a fair question. The confidence comes from a couple of things. First, hitting those high grades 80-100 meters below the existing resource is a strong indicator of depth potential. It's not just infill drilling. Second, they've identified 4 mineralized chutes, but only 2 are in that resource number. So there are known targets right there to drill and potentially add tons and ounces quite quickly. And third, their geological model seems to be working as Modersite. They predicted finding mineralization there, and they did. That success builds confidence in their targeting for future drilling along strike and further down plunge. It suggests a system that's open.
Got it. So what is the current resource estimate at Old Creek? And how much potential upside do you realistically see based on these recent findings?
So RUA has currently identified 4 of these distinct mineralized shoots, but as you said, only 2 are actually incorporated into their current inferred resource estimate. That estimate stands at around 700,000 tons, grading about 3.1 grams per ton gold and 1.1% antimony.
Okay.
Because only 2 of the 4 shoots are included, and because they're hitting mineralization well below that, it really leaves considerable scope for resource growth through more drilling, both, filling in the gaps within the known zones and, more excitingly, stepping out to test the full extent of these high-grade discoveries at depth.
And it's not just gold they're hitting, is it? You mentioned antimony quite a bit there.
That's correct. And that adds another interesting layer to the RUA gold story, the presence of significant antimony values alongside the gold.
Why is antimony significant?
Well, antimony is actually classified as a critical mineral in many jurisdictions. Its demand is growing for use in various modern technologies, things like batteries, flame retardants, alloys.
So it adds potential value.
It could potentially enhance the project's overall economics, yes.
Yeah.
Plus, remember RUA's extensive regional land control, that 95% of the district. That gives them a lot of additional exploration optionality across the broader Reefton area, beyond just Old Creek.
Okay. So boiling it down, what's the key takeaway with Rua Gold? What makes them a compelling story in that often very crowded field of junior explorers?
I think RUA Gold possesses several key attributes that, frankly, many junior explorers lack right now. One, they have that district-scale land package and a historically proven high-grade gold field. 2, they are consistently hitting high-grade mineralization below their existing resource. That's huge.
Demonstrating upside.
Exactly. 3, they seem to be employing proven and sophisticated targeting and geological modeling methods that are actually working. And 4, they have a clear, focused strategy for expanding their discoveries. They know what they're looking for and where.
So you're suggesting that if, or maybe when, we see a more broad-based rally kick in for junior gold stocks, Rua Gold seems well positioned to potentially be one of the leaders in that group.
That's certainly the investment thesis here. Given their strong geological fundamentals, that clear potential for significant resource expansion, RUA Gold has definitely positioned itself to be among the first movers, potentially if the market starts to more broadly reward real exploration success and discovery momentum in the junior sector.
Okay, so let's recap quickly for our listener. We've looked at 2 different ends of the junior spectrum almost. G Mining Ventures offers this compelling story of near-term gold production, backed by robust, institutional-grade project economics. It represents a perhaps lower-risk way to gain exposure to rising gold prices through development.
Right. Closer to cash flow, less geological risk remaining.
Then on the other hand, Rua Gold presents more of a higher risk but potentially higher reward opportunity, driven by that potential for significant high-grade discoveries within a historically rich but maybe underexplored gold district.
Precisely. Exploration upside versus development certainty, broadly speaking. And this really leads us to a crucial question for you, our listener. As you consider this current gold market and these different kinds of opportunities within the junior space, what kind of exposure really aligns best with your investment goals and, importantly, your tolerance for risk?
So you really need to ask yourself, are you primarily drawn to that potential for early-stage torque?
Yeah.
That rapid and significant share price re-rate that can sometimes accompany a major discovery.
The home run potential.
Yeah. Or do you perhaps prefer the relative security and visibility that comes with near-term cash flow from a company like GMIN that's moving decisively towards production? Or maybe you're considering a more balanced approach, something that incorporates both ends of that risk-reward spectrum.
Because look, if this gold market maintains its upward trajectory, if prices stay strong or go higher, the biggest risk you might ultimately face is simply remaining on the sidelines, missing out altogether on the potential re-rating of these well-positioned companies.
Whether they're the near-term producers or the explorers who might be on the cusp of something significant.
Exactly. It's definitely something important to consider, I think, as you navigate this current landscape for gold equities.